This is Your Money, Your Wealth.
Welcome to another edition of Your Money, Your Wealth. My name is Joe Anderson, president of Peer Financial Advisors. Of course, I'm with the big man sitting right over there, Big Al Clopine. Got a great show lined up for you today. If you're a little worried about losing a little bit of money in the overall markets, we got a great strategy to help you preserve your capital. And most of you are not doing this. No, it's not a tricky investment play. It has everything to do with taxes. So that's what's on my mind today. Hey, when you go into retirement, one of the biggest expenses that you will have is the amount of money that you pay in tax, depending on where your money's held. There are $22 trillion sitting in retirement accounts, 401ks, 403bs, TSPs, and the like. When you pull money out of those accounts, you are subject to ordinary income tax. The IRS established these accounts under ERISA in 1974 when the top marginal rate was 70%. It's almost half that now, and you got baby boomers retiring in droves, taking these dollars out, and the IRS is salivating right now of how much tax they're going to collect. If you're worried about losing money in the markets, think again. You're going to lose so much more to taxes. To bring in the conversation, let's bring Big Al. Big Al, taxes, huge expense in most retirees' balance sheets. So let's talk about some strategies on how we can help them reduce the taxes, because if they reduce tax, guess what? They can reduce the risk in their overall portfolio.
Well, that's absolutely right. And when you think about it, if you can save money in taxes in retirement, then you can make your money stretch a lot further. And one of the best ways to do this, one of the best strategies that we've been given probably in decades from the IRS is the Roth IRA.
Roth IRA is a retirement account that is really awesome. Faux show.
It's pretty amazing, as that video clip just said. So why we're going to talk about the Roth today is if you can understand how a Roth IRA works, you can save significant amount of taxes through your retirement. So right off the bat, we'll get into what is a Roth IRA, and it's just a retirement account, special kind of retirement account that grows tax deferred. We're going to talk about two different ways to get money into the Roth IRA. One is to do a contribution from your earned income, from your salary, and another is to do conversions. You can actually convert some of your existing IRAs and 401ks to a Roth IRA. All future growth income principal is tax-free. And then finally, we want to get into some myths, because a lot of you are not doing Roth contributions or conversions because you're thinking you're confused about who benefits and who doesn't. And we're going to go over that. And Joe, I think if our viewers understood what was available with the Roth IRA, more and more people would be doing it. And a lot of people have caught on, but it's relevant for almost everybody to be considering it these days.
Well, you take a look at the Roth IRA. They've been around since 1997. And so do you have a Roth IRA or a Roth 401k or Roth 403b or TSP looking in your overall retirement accounts? That's the first question that you have to ask. Do you have availability to one? Most of you do, but you don't necessarily know it, or you might think that it doesn't make sense for you. We're going to dispel those myths right now to make sure that everyone at least takes a look at it, because there is no better rate than zero. Any dollar that's in a Roth IRA grows 100% tax-free. Think about it. When you need the money the most, that's when you're in retirement, because you have to create the retirement income on your own. And if you don't have to pay taxes on it, that's a huge deal. So now it's just taking a look, how can you maximize it? How are some ways to get money into this overall account so you can enjoy tax-free income for many, many years to come?
Yeah, and Joe, let's start with what is a Roth IRA. So right off the bat, I would say it's a special type of retirement account where you don't get a tax deduction up front. That's a little different than a regular IRA or a 401k. There's no tax deduction, but what does happen is all future income growth and principal is 100% tax-free. And this is where you can really start to make a difference with your retirement, because if you think about this, if some of your income in retirement is tax-free, you can stay out of those higher brackets. Maybe you can have less of your Social Security taxed. For some of you high income earners, or maybe you have a lot of investment income, you can stay out of the Medicare surtax and all kinds of things by having some of your income as tax-free. And Joe, right off the bat, we get this question a lot, which is, what does a Roth IRA pay?
Yeah, so is it an investment? Is
Right.
it not an investment? Is it more risky than the overall IRA? What are the investment options? Well, if you take a look at a Roth IRA, it's just like your 401k or your 403b or any other retirement account. You can invest in just about anything that you would like. Mutual funds, stocks, bonds, CDs, cash, anything but collectibles and life insurance. If you want to buy real estate, if I look at a single family resident that I would like to purchase, a tenant in common, an apartment building, you could buy any asset inside a Roth IRA. Now, the Roth IRA, all of those assets that are in that account will grow 100% tax-free. Okay, so now just think about this just for a second. When they came up with retirement accounts, so you're putting in your $200 a month or maybe $500 a month or whatever that your contribution is. So you're getting a small tax deduction along the way, right? So you're saving a couple of bucks in taxes. Most of you didn't take the savings that you did in taxes and saved it, right? You spent it. Now you've accumulated this large sum of money sitting in your retirement account, your 401k, your 403b, or whatever it is. Now think about this. Every single dollar that comes out of there is taxed at ordinary income. So your $200 contributions over the last 10, 15, 20 years has now accumulated to $200,000, $400,000, $500,000. Every single dollar comes out of that account taxable. If it's in a Roth IRA, so you're putting in $200 a month into the Roth IRA or Roth 401k. You don't get the tax deduction, but now think about you have $400,000 or $500,000 sitting in those accounts. You pull every single dollar out of there, zero tax. There is no tax. So if you're not looking at a Roth IRA contribution, a Roth 401k contribution, or a Roth IRA conversion, I think you're missing the boat when it comes to true tax diversification. Because Al and I believe that this is the best gift that the IRS has ever given us.
Well, it is, and let's start with who can contribute. So right off the bat, I would say that you have to have a job or be self-employed. So that's who can contribute. So in other words, you must have earned income. But there are no age restrictions on contributions.
Well, I suppose a 5-year-old.
Well,
there's some child labor laws.
Well, they have to have earned income. Maybe they're a model.
Right, well, but you get this. Okay,
Yeah.
so hey, I want to start a Roth IRA for my child. All right, well, how old's your child? Well, 3 years old. Okay, well, the child has to have earned income.
They have to have a job.
They have to have, yeah.
Right,
So yeah,
right,
just put them to
right.
work now. Right?
Yeah, no, not exactly. And in terms of the amounts that you can contribute to a Roth IRA, $5,500 is the number. That's the maximum. Unless you're 50 or older, you get a special catch-up. You can actually do $6,500. Now, there's something called a Roth 401k. Some of you guys have plans, 401k plans with your employer that has a Roth option. So you can put dollars into the Roth 401k. And the amount there is $17,500. Or $23,000 if you're 50 and older. And get this, for some of you, you can do contributions into a Roth IRA and a Roth 401k both, as long as you're under the income limitations.
Yeah, this is a huge deal. And I think a lot of employers now, I think the last study that I read is like close to 60% of large employers will have the Roth provision in the plan. So here's what you have to do Monday morning is you have to call HR and say, hey, do I have a Roth provision in my 401k plan? Can I start putting dollars into a Roth per se inside your plan through your employer? You can put a lot more money into those plans than you can in the Roth IRA, and there's no income limitation. So if I'm making $200,000 a year, and if I have a Roth provision inside my 401k plan, I absolutely can put in the full $17,500 or the $23,000 if I'm over 50. So it's a big deal. That's what we're going to talk about. Now, once we get back from the break, we want to talk about another way to get money into a Roth IRA, which is probably even more confusing. It's called a Roth IRA conversion. It's taking existing dollars that you currently have inside your retirement accounts, taking some of those dollars out and putting it into a Roth IRA and having all of those dollars grow 100% tax-free. If you want to get a free tax review, call our number right now. What we're going to do is to see what makes sense for you. If you think, hey, you know what, I have a lot of money sitting in these retirement accounts and I want to find a strategy to create tax-free income in retirement, here's the number to call, 888-994-6257. Just getting started. Don't go anywhere. Show's called Your Money, and it's Your Wealth.
Does a Roth conversion make sense for me if I'm going to be in the same tax bracket in retirement that I am now? Well, the short answer to that is it depends. So let's assume you have $100,000 in an IRA or a 401k, and you have $25,000 in cash outside of that retirement account. If you wanted to do Roth conversions, and you're in the 15% federal bracket, and you're in the state of California, you'd use up just about all this cash to pay for those conversions. So over here, you've got your Roth IRA, but zero cash left. Now let's do a comparison. You've got your Roth versus no Roth over here. If we go 10 years into the future, and we assume a 7% return per year, you're going to have these estimated balances here, 50,000, 200, and 200. Now what we want to do is look at the taxes in the future. So the tax on this Roth, we know that grows tax-free. We like that, so you still have 200,000. Over here on the IRA, if you're still in the 15% bracket in the future, you're going to have about 50,000 in taxes. On your invested cash, you're going to look at capital gains of about 6,000 on that growth. There is, however, one other tax that most people overlook. If you're collecting Social Security benefits, pulling this 200,000 out of an IRA will create additional taxation on your Social Security benefit, and that's going to average around 25,000. So the total here after tax is only 169,000 versus over here 200,000 with the Roth. So in this example, the Roth clearly makes sense, and you benefit by more than 30,000.